Welcome to Syndicate and REChat. We'll talk about anything and everything about real estate. Here with me today is Michelle.
Hi there, I'm Michelle. So today we're going to chat about projections for the 2023 mortgage rates and the big news we got yesterday from the Fed.
Oh, yes, absolutely. So Fed has raised the interest rate by another 75 basis point, which I don't think this is really shocking to a lot of people because according to most of the economists, that's actually anticipated. So it's just still shocking to a lot of other investors or buyers. And, they thought maybe Fed should be maybe really helping out for the buyers.
So were you expecting any higher or lower? Is 75 percentage points or 0.75 percentage points, was that the expected number?
I think that's pretty much right on the mark. And actually, in my last week's weekly real estate talk show in the Chinese ELA channel and also on our YouTube channel, and we discussed about the Fed is going to raise the interest rate again, and we all anticipate around 75 basis point. That's pretty much, we expect he's going to keep it consistent with the previous 2 or 3 times 75 beeps. So it was not really shocking to, I would say, probably most of the people.
Well, and this year as a whole, it seems like the Fed has increased the rate quite a few times as well.
Oh, yes, absolutely. Well, let's take a look at the rate chart so you can pretty much see visually and how this rate has been hiking up. So as you see from the chart, since 2020 and 22, during that time period, the federal funds rate is almost next to zero. And then early this year, March 2022, and the rate has been hiking up. So right now it's like what, number seventh time, right? So it's close to like 4.25%. And if you look like next, I want to share with you is the historically, the Fed has raised the interest rate. It's, since early this year. I just did talk about this year for now. So March for 25 basis point, May 50. Then the federal has increased the basically aggressively the interest rate in the aggressive way. So 75 basis point since June, July, September, October, now November. And then we're anticipating another 75 basis point hike in December, possibly January. So it's a little scary, especially to most of their buyers.
Well, this is only to tame inflation. They keep increasing super aggressively these last few hikes.
Well, you talk about the purpose about increasing the federal rates is to really taming the inflation, but the inflation really doesn't seem like has been decreased. And right now, I think still around 8.2% last time I checked. So really hasn't really been able to curb the inflation at all, maybe very modestly.
Well, and they've been increasing rates since March this year, but mortgage rates don't seem like they've skyrocketed as quickly.
Right, correct. Because a lot of people thought, oh, wow, the interest rate has been increased. All buyers got scared and then, expecting the mortgage rate is going to be increased significantly, which has been increasing significantly compared to the past 2 years. Past 2 years, only about 2-3%, right? However, it really hasn't been increasing as much as as before. So let's see if we can take a look at this. And the reason why is because there's a lagging effect on the mortgage rate, because banks and lenders, they actually take them a while to kind of to double I would say probably increase the mortgage rate to react to the federal funds rate hikes. So that's why even though the Federal Reserve has increased the federal funds rate since early this year, but the effect, it has not been really kind of 100% reflected by the lenders, because it will take the lenders some time to put some actions together to reflect that. And we basically, how we say it, we say like lag effect in mortgage, just almost like how we use the analogy to demonstrate the point. Is almost like you throw a stone in the lake. So you don't, you see the waves will take some time for the waves to come to extend about, right? So that's why a lot of people anticipating the mortgage rate will be reaching double-digit increase next year because the lag effect. And you can see from the chart and see the rate has been increased, but hasn't been reaching like double-digit yet. And the last yesterday I checked is close to 7.5% for 30-year fixed mortgage rate.
Well, I think 10% double-digit mortgage rates is a little scary for some home buyers. What's the direct impact of all of this on the housing market right now?
Well, obviously, the buyer's affordability will be increased even, will be decreased even more, right? So you think about it's already a lot of buyers cannot afford buying a home right now, not only because the mortgage rate has been increased, but also the home price has been increased significantly as well. So basically like double whammy. And so many buyers, they just absolutely cannot afford to buy, especially the first time home buyer. If you look at the actual data, here's the MBA purchase application index. You're looking at right now, wow, look at this, since the since the Federal Reserve has increased the interest rate, see the mortgage rate has been increased, then you see the application has dropped. It's like,
looks like significantly too.
Exactly. See, this is a major drop, right? And it has been going up and down for the past 2 years. It has like been a, roller coaster ride. But, since the rate has been increased early this year, this is really obvious. You can see that it's just to go drop down like hot potato.
Yeah, it looks like a big change from 2020 to 2022. Do you think it's going to continue to go down like this? And for how long?
Well, nobody has the crystal ball. I don't have the crystal ball either. So we only can maybe make some predictions based on the data we have so far. So how we can see how can we really project it out and always see what's going to happen with the mortgage rate in the year 2023? We're not just say all the way to 2025 or 2030 because it's too far out, right? Because there's so many variables and will impact the housing market. So probably will be the next couple of years and easier and more accurate to see it, maybe make a prediction. So here is an article. I'm not too sure which one coming from, because I read a lot of articles each day. Many news I read every day, so it's really hard to keep track of which article I'm reading from. So this one's talk about when will the Fed stop raising rates? But from the way it's going, so he's not going to stop raising interest rate anytime soon. And even though right now the mortgage rate has reached a 20 year plus year high since 2002, right? Really being the high interest rate right now. But here's somebody from Redfin Economic Research Center, I think Mr. Chen Zhao, and he said the housing market is going to get worse before it gets better. And it's almost like, what? We have to go through a tough period before you see the light at the end of the tunnel. Okay, based on what he's saying, and next year, basically early next year to mid 2023, so the mortgage rate will stay high, will be even higher, and so the housing market will be cooling down even further. Okay, so definitely, so buyers, you have to kind of be prepared, and also the seller too, because I can see seller, they have no motivation to sell the home, sell their homes, because if they sell the homes, they have to buy another one, and they're going to buy at a much higher interest rate. So no seller wants to do that unless they're investors. They don't have to. They can sell the property. They don't have to invest right away. They can hold the funds and wait until the interest rate comes back down, and they can reinvest their assets again, with their capital again. So, and if you look at,
kind of sound like doom and gloom currently, though. So, but I know since 2020, we have also had historically low rates for quite some time as well before this hike.
Right. Well, so, I mean, the thing is, everything's relative. So there's no absolute, right? So if you look at historical data, the mortgage rate is it has been going up and down, but, for quite some time. But even though for the past 20 years has been staying low, relatively speaking, for the past 20 some years. But if you look at the 1980s, the interest rate has gone up to 18.36%. So compared to current rate at 7.5, it's not even as half of that rate, 18.36. So I don't want it to, sound like pessimistic. There is a big room basically between 7.5 to the highest point, right? I'm not saying
Absolutely.
I'm not saying the mortgage rate would go up that high, but I'm saying that, it's possible to go up higher, but exactly how high, nobody knows, right? So at least so far, I'm thinking at this point, 7.5% interest rate is high, but really it's not the highest.
So you talked about how this increase will last through 2023. So how and when does that change? So there's another article I have came across. I thought it was very interesting. It's coming from MBA, Mortgage Bank Association. I thought I would like to share with viewers. This one, the title saying that the mortgage rates will fall to 5.4% as a recession is likely to hit the U.S. economy in 2023. So MBA, they basically just saying that because the Federal Reserve has so aggressively increased the federal funds rate, so that would be the cause for the economic recession next year,
right? So then people will losing their jobs, the unemployment rate is going to go up, and the household income will be reduced. So this will be all slowing down the economy. So I don't think the Federal Reserve wants to see that happen either. So then they will have to do something about it. So what's the best way for them, best solution for them, which will be decrease the interest rate. So they will be decreased interest rate in order to stimulate the economy, just doing what they're doing, like opposite almost what they're doing right now. So, but to buyers, you're looking at is really, again, high interest rate and also high inflation rate that both combined together will really suppressed the home price in many markets in the United States. So this probably we can talk about which markets probably will have much worse impact than other areas. There will be, maybe we discuss about this another time.
Well, recession is a scary word to a lot of people, but as we can see that the Fed has reduced rates aggressively as well as increased rates aggressively.
Oh, yeah, absolutely. So if you look at the historical data, so how Fed has cut the rates, and they actually also was very aggressive. When the time comes, they need to cut interest rate aggressively, they will do so. And probably even more so than right now, they increased the rate. If you look at the data, I pulled this together for viewers to take a look. So let's just go back to 2008, when we go through the housing bubble. Look, the Federal Reserve, Fed has decreased the Federal Reserve rate, federal funds rate, and by 100 basis points. That's much larger scale than currently they are decreasing by 75 bips, right? It's 100 bips. So they're pretty aggressive. And then now you look at the most recent 2020, when we'll have this major issue, since I cannot say that word. So I'm just saying that back in 2020, we have this, recession as well. But very brief recession, I would say, just last a few months, but still Federal Reserve, they actually also decreased the interest rate. They're actually very frequent, just almost like, right next to each other. So normally they decrease the rate and have, there's some, like I would say, interval. You talk about 4 to 6 weeks or so. And here is, the same month, in only a few, like
only 2 weeks. Yeah.
Yeah, 2 weeks. And, roughly 2 weeks, they reduced the federal funds rate by 50 basis points. And then they reduced again by another 100 basis points. You can see that they really just like, wanted to aggressively save the economy, because at that time the recession was for a few months. At that time they wanted to not to have the negative economic impact, so they are really taking the action to basically to save the economy at that time. So you can see that Federal Reserve can increase the interest rate aggressively. At the same time, when the time comes is necessary and needed, they will also decrease the interest rate aggressively as well.
Well, you talk about 2020, so it's been 2 years, a little over 2 years. It has been a roller coaster, a hot market, a cool market, high rates, low rates.
Yes.
So then what about today's home buyer? We had the low rates. Now we have high rates. What do you do?
Yeah, absolutely. And so we have gone through a lot for the past 2 years in terms of, I'm just talking about housing market here. So buyers have experienced, like you said, which is, I would say, honeymoon period. But very few buyers actually, enjoying the honeymoon, I would say, or seize the opportunity to enjoy the honeymoon period, which is shortly after pandemic, right? Oh gosh, did I still say that word? but very few, seriously, very few buyers really took advantage of that back in what I would say probably May, June of 2020. That's really the best honeymoon period for housing market, is you have the low interest rate and the low home price. If people didn't recognize that, that's such a waste, because at that time, I still remember I was on the Chinese in LA real estate talk show interviewed by Rain, and I encouraged buyers to take advantage of that. And then most of buyers thought, Cindy just say that because she's, that's her profession. But no, I would say probably people that didn't listen to me at that time, they should regret right now. They should have taken advantage of that low interest rate, low home price at that time. And then after
best
that,
of both worlds.
Exactly, best of the both world. And so after that honeymoon period is gone, and then you see what? Super high price, right? High home price, because the bidding war, everybody wants to buy homes. You have 30, 40, even 50 bidders. And you can see people go to open house. The lines starting from here to all the way 2, 3, even 5 blocks out. And it's just super, super competitive market. And so the home price has been pushed up. So you're talking about people paying way above asking price to buy a home at that time, even though the interest rate is low at that time still, but they pay a lot of extra, on the home price. So then after that, the federal Fed has decreased the interest rate, and then the table has turned. Now all of a sudden, now just going to and phase into another situation, which is where we are right now, is the relatively lower home price, but high interest rate. So now it's going to another phase. The buyers now get scared as, oh my God, the super high interest rate. What should I do? Even though the home price has come down a little bit, but they still just have this interest rate shock. Think about it. They are so spoiled for the past 2 years with low interest rate, already have that mentality, state of mind, think about 2-3%. All of a sudden, if you have to adjust it to 6-7% or even higher, they just find it's really difficult to get used to it, right? So they just have this
sticker shock.
Sticker shock. Yeah, exactly. Sticker shock. And also, because the upcoming recession, now we're still waiting for the official word, about the recession. So that's why, and worry about the recession, also worry about the rising interest rate. So many buyers basically just stop thinking about, even buying home right now. And they just basically still not sure what would be the right solution for them. So I get a call a lot from people, and they just say, hey, what should I do? And what would be the best solution? But especially for the first time home buyer. So I'm just basically have two tough choice. Either I take the bullet, to buy the home at high interest rate and a relatively low home price, or I'm going to have to pay high rent. Right. So what would be the best?
Well, what is the best option? Exactly. Yeah. Is it better to have the lower price and the higher interest rate, or is it better to have the lower interest rate? What does the home buyer do?
Well, there's no perfect solution, I should say. There's definitely no perfect solution for everything. However, you just have to choose which way is the best with the current let's say the variables. It's almost like solve like math problem. I always look at things almost like solve math problem, because I think I'm Asian, because most people think that you should be good at math, right? But I think a lot of problem is to me is a math problem. It's really about like in this equation, right? How many variables you have, how many fixed factors you have. So in this problem, really the fixed factor is that once you buy the house, you cannot go back to the seller and renegotiate the price. You cannot go back to call the seller and say, hey, I think I overpay your price. I think I overpay your house. I want to renegotiate. You need to return some credit back to me. No, that's impossible, right? Who would do that? So there's no way you can do anything about the home price. Then what can you do then? So in this equation, the variable is interest rate. So basically, you can get high interest rate right now to buy the house at lower home price. Kind of offset about what higher home price, but lower interest rate, right? So it's kind of like, give and take is almost like cancel each other out, like offset. But since we're already in this phase, just do the best you can. So now the variable is interest rate. So why not buy a house at a relatively low home price and then get high interest rate? You can always refi it, which leads to the concept that I actually shared with with many of my fans on social media about marry the house, date the rate. Let me show you something. It is probably more visual. So marry the house, date the rate. I really think this is the best solution. And just because I treat this as a math problem to solve, in this equation, the house is a fixed factor. The rate is a variable factor. So I'm just going to find a solution to control the factor that I can control, which is interest rate. And then when the interest rate come down, guess what I can do? I can always refi. And why I can do refi? And then people say, "Oh, Cindy, you're horrible. You're misleading people." Because then you take risk to get a high interest rate, and the risk is the interest rate risk. What if it's not coming down and still going up? I say, yes, there is risk to it. Absolutely,
well, there's a risk to everything.
First of all, there's risk to everything. Secondly, is that you wanted to see which risk is worth taking. Right? You want to calculate risk. What I mean by calculate risk is because you need to assess the market, and you look at the data, you collect the data, say, hey, is the risk worth of taking? Why? So let me show you why. Because the home price appreciation seems to be still going upward trend, still in the upward trend. So you can see that this data is not from me. This data is from the poll from a poll of the economist. They predict the home price appreciation will still go up in the next 5 years, especially like let's take a look at this year's data to see how accurate they are. So they're basically saying that, this year, the home appreciation will be 9.3% for year 2022. So we already, I don't have the latest data from October because, we just finished October. So the data has not come out yet. But the latest data we have is September. So US home price up 7.5% compared to last year. So basically means that home price has appreciated 7.5% in September this year. So we have another last quarter. So between 7.5 and 9.3, perhaps just for the last quarter can make up the difference, right? So this prediction is not too far away. It's not too far apart from the real data, right? From the market data. So in my opinion, I think this is pretty accurate just for 2020-22. But for next 4 years, I don't know because still unknown, right? Still in the future. But their prediction is that for the next 4 years, so the housing market will back to normal. The average home price appreciation will be normal, which is between 3 to 4%. So you look at 4.19 for 2023 to 3.12, 3.46 to 4%. It's really kind of even out, just back on track, come down.
81,000. That's a pretty good appreciation for an average household in 5 years, as opposed to renting.
Right. So that's why I'm saying this is calculated risk because the home price is still rising, still going up. If the home price equity is going down, you don't think the price, and the interest rate, you still take the interest rate risk. Yeah, that's a big risk to take. But if you see the future home appreciation still going up, and of course, like we just talked about, Fed is not going to increase rate forever. They have to do something once the recession hits the economy, and they have to keep the economy under control. They have to do something about it, and a decreased interest rate is the best leverage for them. So this is really a calculated risk based on what we just shared with you. And again, I always emphasize, when you buy a property, always make sure that, of course, you're willing, but also at the same time, you have to be able to afford it, and you are ready and able. And on top of being willing, obviously, you have the needs, you have the demand. Not demand, but I say you have the needs and wants to buy it, but you really have to overall assess your financial and family situation, make sure that you are ready and able to purchase the home. So that would be my suggestion.
Well, exactly. Buyers don't want to pay higher rates forever. So it seems like refinancing down the line seems like the best solution long term.
Right. Long term wise, because still home equity is one of the largest assets for the, for the most households, right? That's pretty much where they accumulate the wealth throughout their life. A major asset. So historically speaking, home price has gone up, consistently, especially for the recent years, especially for the past 2 years, right? So if you're not seized the opportunity to have this, in my opinion, it's more like save, like a piggy bank. If it's a piggy bank, is that right way?
Piggy bank.
Piggy bank, thank you. It's like have the piggy bank, right? And also that's the best way to hedge against inflation. And inflation being so high, you want to have something can help you to hedge against that. So why not? So I think building up the asset, the wealth for you at the same time, hedging against inflation, that's, one stone, two birds.
Exactly. Well, I think we've talked a lot about, the Fed hikes today and what to do about it and predictions in 2023. Do you have anything else to add?
I think that's it for today. We will share more market updates and some data with us, housing data with you in our next episode.
Sounds great. All right, everyone. Well, thanks for watching. And if you liked our content, please make sure to like and subscribe, and we'll see you next time.
Yes. See you next time. Thank you.